Oh, good morning. Gary Shapiro, Southwest Financial Center. We're going to talk taxes from A to Z, and this will be the first installment A for annual contribution limits. And we're talking about retirement plans, and the most common retirement plans, of course, 401ks. That contribution limit went from 18,000 to 18,500 per year. You designate a percentage of your income. Employers may match being the operative term. And if you're 50 or older, you can do a catch-up contribution of another $6,000. So keep that in mind as a great way, base-wise, of putting together retirement plans. Those that don't benefit from an employer having a 401k plan, of course, you could do your IRAs. Your IRA has a 5,500 annual contribution limit, and the catch-up is $1,000. Certain of these numbers are guided by congressional mandate. Certain numbers or limits are by cost of living, inflation adjustments. And thankfully, in the last tax law that came out, there was no huge changes that were initially proposed to severely drop these limits. So definitely take advantage of them. The deductible IRA phase outs, a lot of people ask about those, and the same with Roth IRA phase outs. When you're earning wages, and we're talking about for two people, not for a single person, or an individual with a spouse earning money, because that's a different thing. But singles, you can earn between 63 and 73,000 during those phase out income ranges. You'll be able to deduct that full amount of 5,500 or the annual contribution of a catch-up of $1,000. If it's in excess of that 73,000, then you cannot deduct an IRA contribution on your tax return. It would then, of course, become a non-deductible IRA. And there's special instances to do that, or just set up a Roth IRA. The other great thing about these contributions is the savers credits that you get. And it's a credit, it's a tax credit. And depending again on the income limits, 63,000 income for married couples, 47 to 50 for head of the household, and 31,500 for singles or married filing separate. You can get 10%, 20%, and up to 50% of a credit for your contribution. So if you make a $2,000 IRA contribution, you'll get another $1,000 tax credit on your tax return. So it's definitely a good thing. There's such things as after-tax 401k contributions, a simple IRA as opposed to the SEP IRA, and or solo 401ks for individuals, especially those high-income self-employed individuals. But a simple IRA, you're allowed a $12,500 contribution and a catch-up for those over 50 and over of another $3,000, making it a $15,500 IRA annual contribution amount. And there's a few other items that would apply to certain individuals. And there's a new term that's called a QLAC, QLAC, and that's a dollar limit amount of your fair market value of your IRA or 401k that's now rolled over, that you can invest in what's called a qualified longevity annuity contract, similar to the old style pensions, defined benefit plans. Setting off a portion of your IRA that otherwise is subject to the 70.5 minimum distributions age 7.5, and you have a required minimum distribution (RMD) that you have to get and actually receive from your IRA. So QLACs, you can set aside a portion off your IRA, and and you don't necessarily have to start taking distributions, and that would offset from this RMD. So that's definitely something new and helpful for those that don't require a portion of their IRA, to live on, and just doing a set aside or doing an annuity as a type of sub account of your IRA is definitely a good thing. So there's an awful lot of details that go into pages and pages of um, information dealing with retirement planning and annual contribution limits. See your tax and or retirement planning professional for more information. So that's A for annual contribution limits. Have a wonderful day.